Even though Unity Software stock is bouncing off the lows of the year, it's still down 45% year to date. So investors looking to buy this stock on the dip are curious if it's a good value at current prices. I'll answer that question in this video looking at the company's trailing 12-month revenue, its cash flow, its prospects over the next 5 years, weighing that all against its valuation to determine if long-term investors should buy Unity Software on this dip in 2024.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So you can see from this price chart year to date in 2024, the kind of year Unity Software is having. It was all downhill to start the year, heading all the way down close to being down 75%. And then the company's turning things around in recent weeks, and it's bounced off those lows and creating some momentum, thankfully, for investors that have been in this stock all year long. Now, in its latest quarter, which ended June 30th, the company's free cash flow jumped to $79.6 million. That was up from $33 million in the same time last year. Even though the company's profitability has been volatile, the company undertook some restructuring charges, which are sometimes non-cash expenses, which can appear that the company's profits are falling, but that's mostly accounting profits, and sometimes those don't actually result in changes in cash flow. Thankfully, its free cash flow is still doing very, very well. The company is making progress on that front. Longer term, Unity Software had been experiencing revenue growth until recent quarters where revenue turned downward. That's why the company took some restructuring charges. Management chose strategically to exit some business that it felt was not profitable. So that created a headwind to revenue and profitability, but longer term, management felt it was the right decision to make. Revenue at $2.06 billion is down from the peak, sure, but if you look back longer term, revenue is still up considerably from 2020 when it was closer to $600 million. The company's gaming development software is popular among developers, although the relationship between the developers and itself has been damaged due to some pricing decisions management made and then reversed and then returned. And so that created some friction between itself and developers. However, the quality of the software has been something that gaming developers have appreciated. And its cash flow from operations to sales over the 5-year period has shown improvement. And I showed you the most recent quarterly results where the free cash flow jumped considerably. Longer term, it's also on an uptrend, even though it's been volatile in between. 13% cash flow from operations to sales is up from around 2% in 2021. Even though there's some ups and downs in between, if you draw a line from 2021 till the most recent period, you can see a nice uptrend for Unity Software. That's what I like to see over time, companies making progress, improving critical financial metrics, and showing that there is economies in scale, especially if you are a software technology company, because those are inherently lucrative for economies in scale. Those because you spend a lot of money up front developing the software, developing the technology, and then as you grow the business, as revenue grows incrementally, many of those revenues lead to straight to the bottom line because you don't have a cost of goods sold associated with each sale. It's kind of the opposite of, let's say, a car company where each time you sell a car, you have to build that car, and that's a lot of material and labor that goes into each individual car that needs to be sold. That's not the case with software, where you spend a lot of time and energy and money and effort in creating the software, and then each incremental revenue or each dollar of sales doesn't come along with the incremental cost of goods sold with each sale. And so if you develop more and more sales and you grow and grow and grow, the difference between your costs and your revenue expands, and that leads to greater profitability on the bottom line. The key is, though, to reach those larger scales, to reach those larger levels of revenue efficiently. Sometimes software technology companies, knowing that scenario, knowing that they're foundationally built to benefit from growth, they spend too much variable costs like advertising and labor to achieve those levels of scale. And sometimes they end up not achieving those levels of higher scale. And at the same time, they're spending too much money. So Unity Software, based on the trend line we're seeing with the cash flow from operations, is not one of those companies that's spending too much to reach those higher levels of revenue. And you could also see this in the company's return on invested capital. While it's still negative at 13%, you can see a clear uptrend over the years for Unity Software and its return on invested capital, improving from negative 24% all the way up to negative 13%. And given those foundations of the software business model, I wouldn't be surprised if the company over the next 5 years turns positive and starts reaching higher levels of return on invested capital. Now, the analysts on Wall Street that are following Unity Software stock, they expect its earnings per share will grow at 149% each year for the next 5 years. Now, a number this high, I tend to discount, especially with Unity Software, partly because of the restructuring charges the company experienced. So it might be growing off of a unrealistically low point in earnings per share because of those massive restructuring charges. And so we can kind of discount those growth numbers and look more to next year. Next year, the analysts on Wall Street expect the company to increase its earnings per share by 36%. And the sales growth estimates are not this strong. Sales growth is going to be in the single digits, according to the analysts that are following Unity Software. But given those restructurings and layoffs and cost-cutting efforts the company has implemented in recent times, it's reasonable to assume it can increase profitability next year, even with mediocre revenue growth on the top line. Looking at the company's balance sheet, it has net long-term debt of $969 million. This is long-term debt minus cash. So this is long-term debt after accounting for cash, because you can always use your cash to pay off debt if you find it strategically beneficial to do so. Now, looking at the long-term debt to revenue, you can see that it has about 50% of its annual revenue in long-term debt, which is a relatively reasonable percentage, not very, very high and not low. This isn't one of those situations where you say the company has a pristine balance sheet with zero debt and billions of cash on hand. It's not one of those situations, but it's also not one of those situations where its balance sheet is a big risk. It's a primarily neutral balance sheet for long-term investors. And finally, looking at the valuation, Unity Software is now trading at a forward price to earnings ratio at 29, which is up considerably from earlier in the year where it was trading at a forward price to earnings of closer to 16. But it's still down from the peak valuations where it was trading at a forward PE closer to 50. So I've had Unity Software stock rated as a borderline buy, meaning it's between a hold and a buy. It's kind of like hovering that midpoint between a hold and a buy here. And I last updated that recommendation on May 17th. And looking at the company's recent performance, I do like the improvement in free cash flow. However, the valuation has also increased to offset that. And so I don't think there's been enough change in the company since I made this last recommendation to change it one way or another. And so I'm keeping the stock rated as a borderline buy as of September 27th. Hey everyone, so many of you have been asking about my investing strategy, and I'm excited to announce that I've written a book that's available for sale now that describes my 6-step investing framework for evaluating stocks. I've added the link in the description below.